Hi, this is Pat Jennings from thebizseller.com, and this is part 2 in my 5-part series on the basics of small business valuation. And in this video, I'm going to give you a very specific definition of earnings that you can use in your business valuation calculations, specifically in your multiple of earnings calculations. In the first video, I talked about how for smaller businesses where the owner is the manager, using a multiple of earnings is the most straightforward, easiest process to use to value your business, but more importantly, to come up with a price range for your business. It's easy for the seller to understand, and just as importantly, it's easy for the buyer to understand. So in this video, I want to get into more detail about what exactly is earnings and which earnings do we use in the calculation. Do we use previous earnings, proven historical earnings? Do we use future projected earnings? Do we use earnings before taxes or after taxes? Why do we use earnings instead of sales? All that kind of stuff. So again, this is for smaller businesses where the owner is the manager. And the best way for you to price your business is based on a multiple of earnings, where the earnings is what is called the owner's benefit. And the calculation for owner's benefit is you take the annual pre-tax profits of the business, the annual salary of the owner, the perks and benefits that are paid out to the owner, interest, and depreciation. And that number, if you use that as the basis of your earnings, will tell the buyer exactly how much money is available to the buyer, or more specifically, how much money the business generates for the owner on an annual basis. Now, a couple things about that calculation. It includes pre-tax profits and it includes interest and depreciation, because no matter who you sell the business to, their taxes and their interest payments are going to be different than yours. So you want to include them in the total sum of cash that's available to the owner, and then your buyer can make their own estimations about what their tax payments would be, how much their interest payments would be. The other big element in there is the benefits. These are things like if you're leasing a car through the business, if you're traveling and putting those expenses on the business's tab. Things like conventions and trade shows. If you like to go to those things, but you don't have to go to those things, well, that's a benefit to you, and you're using the company's money to travel on. The new owner may not want to go to all those conventions or trade shows, and so you want to include that type of perk, like travel, in the owner's benefit, because then that's cash that's available to the new owner. He might want to go to those trade shows, he might want to stay home and spend that money somewhere else on the business, or just put the cash in his pocket. So that's the key concept of the owner's benefit, is that it tells the buyer how much money the business generates on an annual basis for its owner. Now, the second part of this is how many years of owner's benefit do you use in the calculation? I suggest you go back 3 years. Right now it's early 2010. So if I was valuing my business, I would use the owner's benefit of 2007, 2008, and 2009. And what you can do is you can either add those up and divide by 3, and that's fine, particularly if the middle year was exceptionally good. The next thing you could do is you could use a weighted average. And this is where, again, it's early 2010, so I would take 70% of 2009, the most recent year, plus 20% of 2008, plus 10% of 2007, and add those together, and that would give me a weighted average of my owner's benefit for the past 3 years. which I think is the preferable way to do it, because the most recent year is the most important year. The thing you don't want to do, because you're going to get a lot of resistance from the buyers, is if you just take last year's owner's benefit, because that's just 1 year. And particularly if last year was way better than any year you've had in the past, buyers aren't going to put much credence in that, because there's a lot of ways you can manipulate your bottom line profit for 1 year. So however you value your business, really the standard is that you take 3 years worth of numbers to do that. Even if you were going to use a rule of thumb where you're going to use sales, you don't want to just use the most recent year, because that just doesn't have a lot of credibility. So use the last 3 years. And I would suggest using a weighted average, because the most recent year is the most important year. Now, if 2008 was a little bit better than 2009, then you might just want to take the last 3 years, total them up, and divide by 3. But the key here is that the owner's benefit, the definition of that and the calculation is, again, your annual pre-tax profit of the business, the owner's salary, the owner's perks and benefits, interest and depreciation, and then use a total that is an average of the past 3 years. And you want to use that as the earnings in your multiple of earnings calculation, again, because the owner's benefit tells the buyer the amount of money that the business provides for its owner. And as we learned in the first video, that's the reason they're buying your business, is how much earnings, how much benefit, how much income is the business going to generate for me. Now, in the later parts of this series, we'll get into the multiple and how do you decide what number to multiply that owner's benefit by. But for now, the key concept and the key metric is the owner's benefit. And so what you want to do is you want to go back and calculate that for the last 3 years, either just as a straight average or as a weighted average. Now, if this is the first time you're watching one of my videos and you want to get more information, tips, advice on selling your business, not just on valuation, but on all aspects of selling your business, you can go to thebizseller.com and you'll see a sign-up box there. You can enter your email address and name to sign up for my Sell Your Business Tips newsletter, which is a weekly newsletter. Sign up for that and we'll immediately send you our current issue. And then every week thereafter, you'll get a new issue with new tips, advice, information on all aspects of selling your business. So that's thebizseller.com. Enter your first name and email address, and the current issue will be on its way. And otherwise, I'll see you in part 3 of this series.